Hi everyone, I wanted to provide an overview of problem number 3 from chapter 16, which looks at the valuation rules for investments. So let's unpack what that means. We are a company, okay, and we'll imagine we're Cullenber Company, and we've gone out and we purchased these various investments, okay, having them written up on the board from what it looks like on my end. Your numbers might be a little different, but the facts should be similar. We own some common stock, and then some debt. So we've gone out and purchased stocks and then some bonds. And they're investments to us, which means they're assets to us. The question here is, what do we value those assets on our balance sheet? That's ultimately what this question is getting at. And there are rules around this, around how you value stocks and bonds that you have purchased as investments. The rules can get quite complicated. I just want to make that point up front. We are scratching the surface with this problem, and my main impetus for you guys is just to know that these rules exist. If you were to go into an area where you had to, do a lot more of accounting with investments, you'd have to get further into these rules and kind of, understand the nuance. And I could give you, additional kind of problems here from extra credit. If anyone is interested, please let me know. I'm happy to give extra credit that kind of introduces you to more of the nuance. For now, let's dive into the equity rules and equity valuation, because it's interesting and it kind of makes sense that what we need to do here is we need to understand how much of the stock do we own in the other company. Now we need to kind of make sure we're clear on what's an asset and what do we mean by the asset, meaning the investment, and equity. So we are Cullenber and we own Idleman stock and also Pickerel Inc. stock. Okay, so we have ownership in each of these companies. Now, let's do a quick little kind of equity, and actually let me do capital here, just to keep it, I'll just do stock, common stock, for Idleman, and then common stock for Pickerel, okay? Now, what this is saying, and we have to focus in on this fact here, this 30%, 10% and 30% ownership. Well, what this is saying is that Cullenber's investment in Idleman accounts for 10% of their stock. So Cullenber owns 10% of Idleman Company. Cullenber owns 30% of Pickerel Inc. Okay, so 30% over here. And imagine it this way, just one way to think about it. Imagine that, and just to keep it super simple, imagine that Idleman Company, and I'm going to kind of just use a really simple example. Imagine there are 100 shares outstanding. This would mean that Cullenber owns 10 of the 100 shares outstanding. If there are 100 shares outstanding over here on the Pickerel Inc. example, then it means that Cullenber owns 30 of these shares. So that's what we mean by 30% and 10% ownership. That ownership percentage matters for these rules, and the rules are here. Okay, what we have to understand is, how much ownership do we have? Because that ownership percentage will determine the value that we use. Fair value is, and by the way, we're given these values in your problem, okay? You don't have to compute these. In other, in a more complicated scenario, you would have to actually compute the fair value, the equity, etc. Fair value is, if you were to sell the stock today, how much would you get for it, okay? Kind of like if you were to sell any asset. What could you receive in exchange for a willing buyer? That's fair value. It's pretty straightforward. Equity is a little bit more complicated. Equity is, and by the way, fair value is if you own 20% or less of the stock, okay? In this first example, they own only 10%, which is less than 20, so we are going to show that the value of Idleman stock on Cullenber's balance sheet is going to be $108,000. Okay, Pickerel's a little bit different because we have 30% ownership here, which brings us into here, into this realm. So this is Pickerel, and Idleman is like here. Okay, so fair value we just walked through. Now Pickerel stock is owned 30% by Cullenber. So that means we need to use the equity value of the stock. Now equity is a little bit more complicated, and basically one way to think about it is as Pickerel makes income, okay? If Pickerel makes income, a share of that income rolls up to Cullenber's income as well, okay? And the idea here is that by owning a greater share of the stock, they have more control of the company. And so the method here of how we account for the value of the stock on the balance sheet is different based on the degree of control of ownership. So for the common stock of Pickerel Inc., we're going to use the equity value. Now, I want to encourage you, I want to pause here and encourage you, look in the book. The book goes through examples of these different rules. And like how is it that, when the net income is earned by Pickerel, rolling up into Cullenber's income, you'll get an example of that in the book. This valuation is $251,000. This is what would show up on Cullenber's balance sheet as the asset value of this investment. Final note, the debt investment. Debt investments also have their own rules. And for a debt instrument, it is how long do you intend to hold the bond or the debt instrument, okay? I'm going to use the word bond just because we looked at bonds, and those are typical long-term investments. In this instance, in this example, we're going to use fair value. One thing just to note is that the rules are different if you intend to hold the bond until maturity, meaning you don't plan on selling the bond, then you're going to value it using the held to maturity method, okay? If you intend to hold the bond for a short period of time, maybe only less than a year, you're going to use fair value. And if you intend to hold the bond even longer term, but also have any intention to possibly sell it, you'll also use fair value. So fair value is what we're going to use for the bond. The key here again with this problem is understand that companies do have rules that they have to use when they report the value of the investment on their balance sheet. The rules can be complicated. If you're an accounting major, you'll get more into this in intermediate. You'll get examples. And again, if you're interested in doing an extra credit problem, I'm happy to give you one where you can dive into this nuance in particular in more detail. Okay? Thank you, and keep in touch with questions.